Ladies and gents, good evening to you. Let's clear the decks, phone out the way, pens out the way, notes about today out the way. Market is pretty snooze fest today, a little bid creeping in. Nasdaq just trying to get back up to gap fill. Same with the Dow, same with the S&P, gold a smidge of a bid. We have Trump talking at a quick conversion, I think 8 o'clock UK time. I think that's to do with the defense, the Golden Dome, as he calls it. So I think that's to do with that, but I'm sure he may. I don't know if he's taking questions. Who knows? He might drop another bombshell there. Market strong. Equity market is strong. There is a study, not study, there's data to suggest that a lot of the hedge funds are scrambling to get back into this. So they put a lot of money out of the US, thinking, hey, I think the tide has turned, we'll put some into Europe. But from what I see, there's a lot of funds who are now scrabbling to get back in. And we're seeing this in the market at the moment. You know, any dip is being bought, even after the Moody credit downgrade on Sunday night, Monday dip before the opening bell, pushed back up and then rallied to kind of fresh highs on this move for the Nasdaq anyway. So who knows? The trend is the trend, and whether we like it or not, price action is price action. So quite a good day to be talking about momentum ignition. I do think. So whatever you're trading, the chart is king. The chart is always going to be king, whether you like it or not. That's just the nature of the beast. I remember, which one was it? So the bull, a real bull run, and it was called the most hated rally of all time because everyone thought it was going to be the end of the market. It never was. It carried on and it ground and it kept going. It kept going and going. I missed the 1990s, late 90s rally. Didn't start trading until 2001, probably 2003. So I missed all that. But apparently that was exactly the same thing. It was like, hey, this is so overvalued, and it just kept going and it kept going and kept going. Now, not comparing now to that because we've still got some way to go before we even hit the prior highs, but the same theme. You know, leave all your IQ at the front door when you're trading. It's like, hey, what's the market telling me? The market's telling me this until it shifts. So I'm going to either align with this or I'm going to wait. If you only want to take shorts, then you have to wait. You're trying to pick the top is going to kill you. It will just wipe you out eventually. Or you say, you know what? I like trading the price action as it's unrevealing itself, as it's unfolding. And so whether you like it or not, you've got to kind of accept the fact that price is strong at the moment. I'm talking about the equities. Other markets are obviously different. A lot of rotation going on some of the currency pairs. But hey, we're not here to talk about each individual market and spend all day and all night doing that. You can do that for yourself. You are your own trader. You are your own analyst. We shall get started with the topic du jour. I'm pretty sure the microphone is on. Someone will shout. Normally flooded in the chat if you can't hear me. So hopefully you can hear me. Hopefully you can see me and sharing the screen. So today we are going to talk. This is, what are we now in this Tactical Trader series? Webinar 3. So we've got one more coming up next week, which we're going to talk about the block risk method. More on that maybe at the end. But continuing kind of tactics and kind of ways to think about trading a little bit differently. Today we're talking about the momentum ignition edge. So, well, man, we're going to cover a lot of ground. How long we got? Hopefully we have time to cover everything. I'll do my very best. If you want to ask me a question, then feel free. I'll get to it at the end. So let's get going right away. We've got a lot of stuff to cover. I think this will apply, by the way, whether you are a day trader, whether you're a swing trader, whether you're trading the currency pairs, the indices, whatever asset class you may be trading via whatever vehicle you may be trading. I think this will be valuable for you. It's not just for scalpers. It's not just for day traders. It's a way to differentiate the different rhythms and regimes in the market and capitalize that as a trader. Because before we start, and maybe a risk of repeating myself a little bit, sometimes I do all these slides, I forget where I'm up to with the slides and stuff. But ultimately, you know, momentum is urgency. It's urgency. It's people executing with a disregard for price and more of a regard for time. There'll be a few times when I'll talk about this, but this is probably a good lens to look at the whole webinar through is, okay, hang on a second. I've got two sensitivities, and you think about yourself, right? You can either be price sensitive, in other words, hey, I'm putting a limit order in, or I'm going to wait for this price, and necessarily have to be a limit, but I don't want to pay up more than that, right? If you're a buyer, I'm not going to pay up more than that. The price matters so much to me. I'm going to wait for that price. I want that price or better. It's $100 or better. It is where in the Nasdaq, 21,400 or better, right? And and you're very, very price sensitive, versus time sensitive is like, get me in or get me out now. An example of that you may use is a stop order, right? Your stop order will say, I just want out of the market now. I'm long, it's gone lower. Here's my stop. I don't care the price within reason. I mean, you get slippage, it's tough luck, but I just want out. But and the same if you're using a market order, perhaps in a breakout, you're like, hey, I'm prepared to pay up a little bit. Obviously, you want it at the best price possible, but then you're more time sensitive than price sensitive. So that's really what we're thinking about here is this sensitivity of the higher time frame participants, the participants with huge resources, doing huge size, and we're trying to identify when they are more time sensitive than price sensitive. And the assumption is, hey, this may well continue. This could be the start of a broader move, hence momentum ignition. We're seeing the ignition, it's bringing other participants in, it's causing that cascade, and it's going to continue on. Whether that is a stop run, whether that is kind of the start of a trend day, we'll cover all this kind of stuff in a moment. But that's the way I wanted to kind of think of things, and hopefully it will really resonate with you when you think of it through that lens, or view it through that lens. Think of it through that lens, you get the idea. So Linda Rashke said, strong moves tend to beget more strong moves. Just like we're doing at the moment, this strong bid that we're getting from equities from the low tends to continue and continue and continue. As developing traders and maybe beginner traders, we tend to think the other way of, hey, actually moves tend to reverse. And yeah, mean reversion does apply, and there's definitely a time and a place for it, but often momentum will continue more and more. So today, how to identify potential momentum shifts and plan trades around those. And thank you to Pepperstone for hosting these, for allowing these to be in existence. We're allowed to talk about almost any topic I like, which is great because I want to cover some stuff that I think is going to add value to you. So if you're not a Pepperstone client, go and have a look, see if they are a broker that might suit your requirements. Okay, make sure I'm on the right screen here. Oh, first of all, I must, should have said this at the beginning, shouldn't I slap on wrist? Of course, please understand the risk is high when you're trading a spread bet, a CFD, or any instrument leverage. You know how it works, guys. We don't have to go through this too much, but leverage works really, really nicely when you're on the right side of stuff. When you've got your leverage dialed up to the max, traders going your way, you make a lot of money. But the flip side is you dial leverage up to the max, it goes against you, you lose money very, very quickly. A lot of traders get caught, the deer in headlights syndrome. Oh, I'm down way more than I expected. Position size is too big. So just be careful, manage your risk with size, manage your risk with stop losses, use all the things you can to help mitigate the risk. Obviously, as a traders, we're trying to maximize the upside, minimize the downside, but it's easier said than done, which is why we talk about all these topics and we go into detail to try to help you do better. But please understand that we are playing this game, if you want to call it that is very high risk. If you don't get it, then please double check all this other stuff and make sure that you're suitable for you. I hate to hear people come into trading who don't really know what they're doing. They lose a lot of money. It's like, oh, if you know what you're doing, you understand that you're a big boy or girl, you say, you know what, I'm going to play the game, and I understand this downside there, but I'm trying to shoot for that upside, then that's fine by me. But just be aware of the risks of what we're doing. Okay, so very brief intro. I haven't got time to be blowing my own trumpet, not that I do anyway. Been training for 25 years. No, not quite. 24 years. And I've got some decent experience to share with you. I'll try and share with you my experience of what I believe works. I'm also in a good position that I see a selection of traders coming up through the ranks, selection of traders who fall by the wayside. So I'm in this unique position where I can leverage on my own experience to share with you, but also others who trade differently to me or maybe kind of a few steps back, if you like, who are on the developing journey and have made things work, so I can see what works for them, different personalities, different styles, and I share that with you as well. So that's the kind of way that I like to put things together. I definitely don't claim to know everything, absolutely not. And I think that no one ever does. No one ever does. There's not a game you ever crack, which is why the game is so enjoyable, right? You're always improving, always getting better as a trader. And one more thing here is always do your own analysis, do your own research, do your own homework, because things take time. And Linda Rashke said this, I'm using Linda Rashke, 2 quotes here from her. The name of the game in trading is to stay in it for as long as possible until you get it. I'm paraphrasing, I butchered that, But effectively, traders bail because they run out of mental capital or financial capital. So you can preserve your financial capital, comes back to risk, preserve your mental capital, then eventually things start to click. You go, I've seen this movie before. I know how to sit. I know to sit out on this one. I know to sit on my hands. I know to be patient. I know to trade this, that type of stuff. So things take time. If you are going to implement a change in your trading methodology, your trading plan, stick to it for a bit. Many traders have this, and it's this curse of just going round in a circle, big ship, like steaming, full steam ahead. You've got a little bit of right rudder, whatever the tiller is, whatever it's called in shipping, and you do a big circle and you kind of got nowhere and you've exerted a lot of energy, burnt a lot of fuel. So go into a sort of a direction, make a course correction, and keep adjusting and shifting as you go. I think that's the best way of doing stuff. But I say, I don't claim to know everything. I've got a couple of decades of experience, but I'm not here saying do exactly what as I say, because that's a ridiculous way to say things. Everyone's different, especially in trading where it's very personal. Okay, let's get rolling. We're going to talk about what is momentum ignition, why does it work, what does it look like, how can we trade it, how can we preempt it, and other uses like stops, adding points, failures. What is the signal? When is it a signal? When is it set up as a trap? Of course, there's no silver bullet. This is not a holy grail strategy. There's no such thing. You know that. I know that. So when we say how can we preempt it, we're looking for subtle signs and clues that, like, hey, is this worth looking for? And does it always work? No, but I believe that it's an edge that carves out quite nicely over time. So we'll explore more on that in a moment. So first of all, let's get the basics down before we get into nitty gritty. What is momentum ignition? How are we identifying it? To me, it is a large, if you're kind of using absolute terms, we loads of chart examples for you in a moment, don't worry. It's a large than average range bar accompanied by strong volume, and they tend to go hand in hand. You know, I'm not a huge let's say fan, that's not the right word at all. I don't look at volume so much. I think it's super valuable, absolutely. I think you should look at it, but the range of the bar big bar range tends to have big volume as well. Very rare do you get a big range bar with low volume. That's just the way it is, because to transact through all the different price levels, it has to have traded. So there are obviously other ways to look at volume, of course, but the larger than average range bar is, for me, is the most important thing of this. I'm not dismissing volume at all. Please don't get me wrong there. I think it's valuable, but when we're looking at this, it's a large range bar, and volume tends to be correlated with that. And this is going back to the urgency. We have buyers or sellers that don't want to wait; they want in now. If you think about what's happening, let's say it's bid at 50. They're saying, okay, I'll pay 51, 52, 53, 54, 55, 56, and they're just buying all the way up. And that's causing that large range bar. Maybe the bar range is normally kind of 3 or 4 pips, make it up, and now it's 10, 15 pips. So it's much more urgency in a short period of time. That shows up on our charts as a big wide range bar, red or green. It doesn't necessarily matter. Again, loads of chart examples coming up in a moment. This usually happens in key zones or after consolidation. Not strictly true, but usually that happens, after we're breaking out of highs, at times of day as well. It's very often we get this momentum ignition. We're going to cover all this, but just wanted to kind of get some clarity and make sure we're all sort of singing from the same hymn sheet, reading from the same page, all those metaphors. Okay, so often it's traders or algos executing with urgency. So it's not just traders, it's algos as well. Algos kicking in, and what I mean by algos is let me see, we'll do a 30-second kind of masterclass, if you like, on algos. And again, not an expert here, but someone wants to buy 100,000 shares, 100,000 contracts, then it's going to snap it in the market because it's going to move the market. It's going to get awful fill, probably hold things depending on what it is. So they will kind of piecemeal it in. They'll do 100, do 50, do 1,000 when they can. And there's different ways of doing this type of stuff. So when the algos are, and actually you can kind of research this, it's all readily available. If you have an algo that's like turned up to more aggressive, your priority is to get filled. And so the algo might hit offers. If it's more passive, you want to hit the bid and liquidity comes to you, liquidity seeking rather than taking, I think they call it. And so general chop back and forth, algos will be sitting on the bid, maybe taking a little bit, resting a little bit, working that order over time, not chasing too much because they want to get a kind of average fill over the day, or the best fill they can. Now, a trader who dials that algo up to maximum aggression or maximum urgency, the algo will start going, oh, whoops, I need to get a fill here. It's been 3 minutes since I've kind of executed. I need to kind of be more urgent. I've not been filled on the bid. Let me hit offers. And so often it's the collection of all that, traders, algos executing with urgency, going back to that initial point of, hey, I'm super time sensitive rather than super price sensitive. Concerned about the order rather than the price. Okay, momentum continue further than we expect in the right conditions. We know this. Trends can continue on. This is a good point. Bottom right. Direction plus volatility. This is why I think momentum ignition, or however you want to wrap this, is actually a very, very good edge for traders because you get two things. Number one, direction. And okay, we're going to understand, we're hypothesizing we're going to get this, we're getting these correct, right? And we're going to dig into this in a moment. But this is why I think it's so good as traders. One, you get direction, which we know we've got to get shredded. If long, it's got to go up to make money. Short, you've got to go down. So fine, direction. But you also get volatility expansion. So momentum ignition is direction and volatility expansion. And why that's so good is, I don't know about you, but we've all had trades, right, where you've taken a trade and it's just gone thump straight your favor, straight away, no heat, no pulling back, no messing around. It's a nice trade to be in. Now, how you manage that is another kettle of fish. It's another ball game, right? You are there going, okay, hopefully you're out into the trade, you're running it, fine. That's a separate topic completely. But if we can identify these trades where the trade goes forward straight away, we don't take any heat, it's far easier psychologically. It's far better on a pocketbook, if you want to put it that way. God, that was like a reference from Jesse Livermore then, wasn't it? The pocketbook. It's far better on the wallet, it's far better on the equity curve. And although we can't obviously pinpoint these all the time, the objective is to try to identify when we might get this, because there's just so much better for P&L, there's so much better for mental state. I don't know about you, but I hate trades where you take them and they're sitting at your entry and you're sitting at your entry and you're expecting it and you're just like, it can be frustrating. Up a bit, down a bit, up a bit, down a bit, and you kind of get beaten death by 1,000 cuts of chop. Chop is the trader's nemesis. Intraday, swing, no one wants that. The beautiful thing is this is two things traders want. Direction, hopefully in the way you're trading, and volatility expansion. We suddenly get a much more aggressive move. The ATR picks up. So now you're kind of in the perfect world. You're at the beginning of that momentum. It drives. All of a sudden you've got cushion. You've got unrealized P&L in your direction, and you've got volatility expansion, meaning if there's a continuation, it's going to accelerate. And so you're going to get much more bigger bars after that. So if you can get it, that's why we're talking about it. I think it's a really good position to get yourself in. Now, of course, if you know me, I'm not here to say this is, you definitely can see this, this, and this and take it. No, no, no. These are tricky trades to get on, but like anything in trading, if you are searching for them, you will find them far more often than if you're not. So what's it called? Reticular activator. If you're in a room and someone says your name, you hear it. You don't hear anything else, you hear your name. I'm really I'm butchering this, but the same with trading to a certain extent. If you're looking for momentum ignition or the things that precede momentum ignition, you're going to spot it. If you're not looking for it, you're not going to see it. Okay, let's move on. So we get this price discovery phase. No one's waiting for pullbacks, directional legs, volatility expansion. I've talked about this before. Okay, so two ways to trade momentum ignition. Well, I believe there are two ways to trade momentum ignition. One is responsive versus predictive. Again, this is my take on stuff. Don't claim to be right or wrong here. I know this works well for me. Others have used this type of model as well, and it works well for them. Others go, you know what, I can't trade momentum at all. I don't like it. I want to trade it. That's fine. So responsive is to identify momentum and assume that it's the start of the broader move. So in other words, you see the clues, and we'll charts, loads of charts in a moment. Hey, I've seen the momentum ignition. Now I'm going to join that. I want to get on board that and run with that, because I think that this is the start of a bigger move. We'll look at some of the clues to determine whether it could be a bigger move, whether it's the end of a move, whether it's a fake out. We never know for sure. Absolutely, we don't. But if we can gather all the clues and be detective and go, actually, you know what, that's worth joining. We'll talk about how to join that as well. And predictive, which is what the one I absolutely love, is tougher, but it puts you in a really powerful position, is being positioned before the momentum ignition hits. You might be like, Mark, I'm not out of crystal ball. How do I know this? We never know, But there are certain times of day, certain positions when you can hypothesize as a trader and say, you know what, an example of stop run. Like, you know what, if we break that high, we could get momentum ignition because we're going to have a stop run. We're going to have more urgency with time as opposed to price. That's how stop runs happen. And I think that's going to be a start of something. So if I'm positioning for that, then as price goes up and breaks through, I'm on as the momentum ignition starts. And very often that can cascade into a bigger move, and we gather a kind of a decent momentum from there that generates a really nice trade. So responsive versus predictive. It's up to you how to position, but just I like to have those in two kind of categories. So predictive, the ways we kind of look at this is the market environment, the daily higher time frame patterns, the current sentiment price response, and the day type so far for intraday traders. Explain more in a moment, but just have those in your brain. Did I miss responsive? Example. Of course, I put an example. So here's an example from the DAX. So you might say to yourself, okay, and if we go back and look at some of these things, let's slow it down a second. Market environment, bullish, rampant uptrend at the moment on the DAX. Daily time frame pattern holding at highs. Current sentiment price response, every dip's being bought. Day type so far. Okay, well look. So yesterday, whatever date this was, can't remember the date of this one. The day before, trend day closing at highs. As you're coming into the open, you're saying to yourself, hang on a second, if we break through the highs and the time of day is right, we could really kick into gear. So the predictive, this is a rough example, I'll give you some more. The predictive side of momentum ignition is to be positioned ready for that break for later in the day, or it wasn't later in the day, so early in the morning here. But you're, rather than seeing it and following it, which is fine, we'll look at that in a moment, you are positioning for that. So maybe on that early dip, maybe the close, you're saying, hey, you know what, there's a lot of kind of pent up orders here. I think we're going to push through highs. And responsive is the same condition cross check, if you like. So daily time frame, all the other stuff, very important, all this positioning trend, expected move of the day, whether we've got trap participants or not, whether there's a catalyst driving it. And this is, hey, we're seeing a burst of momentum, we're seeing a momentum ignition, and actually all those things are lining up. So I'm going to join that momentum because I believe this is a start of a secondary move or a primary move. And actually, I've waited for it to show its hand. And that would be the same chart there. We see the candle here. You can see my cursor. That's our momentum ignition there. Big wide range bar. Off we go early in the morning. And that's the start of a bigger move. Now, the predictor in you would be like, okay, I think if we get going, we're going to take out these highs and we're really going to kind of shift because there's a lot of orders there. The one who's actually saying, you know what, I'm going to jump on the move after I see it. You're kind of waiting for pullbacks, you're waiting for pauses, that type of stuff. A little bit more detail in a moment, but just kind of get the idea in your brain of those two pillars. So direction plus volatility expansion. Volatility expands and contracts, right? We know this, but as traders, I think we often forget this. And what I mean is that we're so caught up in getting direction, we forget that markets will expand, contract, backfill, consolidate, expand, contract, backfill, consolidate. And what we don't want as active traders is to be in a situation where the volatility is contracting, because that's when we get fake outs, right? We get the market going to highs, coming back, sitting there for a couple of hours if you're a day trader, maybe a couple of days as a swing trader, and then eventually it grinds up through highs. And no one wants that. Now, technically, it might be a profitable trade, but you're tying up resources, you're tying up margin, you're tying up focus. So nobody really wants that. Maybe you specialize in that, go for it, have at it, double down on it if it's working, fine. But I think most of us don't like it when we get the volatility contraction. So it makes sense for us to align when we try and get the volatility expansion, i.e. the market's consolidating. When do I think now we're going to perhaps break out? To preempt that, expect the direction to be right, expect the volatility to expand with it, and that's when we get so much more bang for our buck, so to speak. So thinking about how price expands, volatility expands, contracts, expands, contracts, and not only trying to get direction correct, which obviously we have to do as traders, but to try and time with the cycles of volatility. And so, we have this tension that's kind of building up and releases, and that's when the order's just like, boom, firing into the market. And if you think about kind of some of the intricacies of how order flow or how the kind of tape works, to have this expansion is, if you've got an order that's got people kind of sitting there consolidating, buyers, all of a sudden they go on the bid, or sorry, yeah, they go on the bid, they're not getting filled, so they go offer, and they've been filled, so they kind of go on the bid again, they get filled, and that's why we sit in that range for a bit. Now, if you're saying, hang on a second, TikTok, man, I need to get this order done, as an algo saying this, whatever an algo says, I'm sure all algos and say that, but they go, hey, hang on, the variable of we need to get this order done, we're not getting filled quick enough by sitting on the bid. Of course, don't forget, every buyer wants the best possible price. If you're an algo buying 100,000 units of something, you don't want to just pay up. You want to get the best possible price. You can report back and say, hey, we've got a really good price for you. So they're always trying to be passive and let the market hit them. When we get that consolidation, that's perhaps two-way flow, right? They're getting filled. Now, all of a sudden, sometimes it's a time of day, sometimes it's just, hey, we've been here for a certain period of time. They have to start getting aggressive. So they're going to start lifting offers, and that causes the cascade, potentially of stops, potentially of other traders coming in, momentum ignition, right? And then the assumption for us is that those buyers have to continue buying and buying and buying, and that's going to cause a kind of continuation up, and we're going to jump on that move. So this is this volatility expansion, contraction, expansion, contraction. Sometimes it's driven by a catalyst, of course, news, everyone's like, it's repriced and needs to get in now. Sometimes it's just the natural rhythm and flow of the market. So if you take anything from kind of thinking about this, think about this expansion and contraction of volatility. Now, as a trader, if we can align when we think that we're about to get expansion volatility, that works so much better, and it's such a better trade for us. And we know this from the trades you've been in, and you've been like, oh God, just sitting there doing nothing. So, example from the Nasdaq, right? You had this drive from the open. I think you can see my cursor. Yeah, so this drive from the open, okay? And on the right hand side, I've got the daily chart. So the daily chart, where I've got this arrow, is the day after. So Monday, the context for this. So Monday or Sunday night, we had the gap up based on the no, this was the China news, right? The China news came out, China tariff, fine. We got the gap up, all very well, off we go, and we had a good day the prior day. Now we then open and we start to drive, and we have the volatility expansion. Now you look at the daily chart, you're going, okay, we've broken through highs, we've got sentiment's really, really strong, we've got a catalyst, we're going through these checklists saying, actually, you know what, this could be a really decent bid day. If anything, I definitely want to stay long. So you might be watching this, you watch the open, price start to drive up, and maybe you're like, okay, let me want to see what happens first, because it could be a trap, right? We often sell the news events happen. We haven't had that recently, but that does happen. So you see this drive, you see expansion, volatility, and then you see volatility contract, right? You see the kind of the range of the bars go down, it consolidates. And think, if somebody now is working an order, they're working it at 21,050, 55, 54, 61, back to 50. They're getting filled. Now, all of a sudden, they say, you know what? And the longer it stays, now there was a certain period of time, actually, there was a kind of edge case where if it stays there super long, and volume starts to decline, then maybe there's no buyers or sellers really transacting. But if you've still got it sitting there, you kind of go, hang on a second, day charts in line, sentiment's good, all the stuff that we want to check is there. Now, as a predictive trader, you will be buying in this flag and saying, hang on a second, I think direction is still higher as your direction, and I think we've got a short-term volatility contraction, and we're going to expand, and I'm going to take the meat of that. And so you now, that's your hypothesis. Obviously, you have a stop in place if you're wrong, of course, all that stuff, but you're now in a much better position where, as a predictive trader, you're looking for the expansion of volatility and direction. This is where these type of things come in, and maybe you're buying at the bottom of this flag, maybe you're buying a point in this flag. Right? I'm not going to be overdoing the precision here, but your hypothesis is, I think we're going to see secondary, in this case, a secondary momentum ignition kick into gear, and I want to front run that. There is a little bit more risk, obviously, this doesn't just drift lower and lower and lower. That's why I have a stop in place. But I'm going to front run that, because I think if I can get one bar under my belt, I'm now in a very nice position of power. I've got some unrealized P&L. I've got everything, all the boxes ticked that I think are useful for the trade hypothesis. And actually now I can do what I want with it. Do you hold it? Do you run it? Do you add to it? All the stuff we talk about. So, often traders go, you can't, you never know it's going to do this, but there are certain things that you can look at, and yourself from experience, no matter how much experience you've got, these things play out time and time again. Not always, which is why we always have to manage our risk, but putting yourself in a position of power before the momentum ignition, looking at all the clues and thinking about the cycle of volatility, expansion, contraction. We're not going in when it's already high, because as we'll see in a moment, that's a continuation or it's an exhaustion. It's not ignition. So we want that contraction of volatility. We want to say, you know what, looks like a calm before the storm, and a bang, if we're in position there, it puts us in such a position of power. And that's why we can get those multiple RVR trades. We can, even if the hit rate is low, the high RVR more than makes up for it. And if you're reactive, you'd be buying after the ignition. So you'd say, okay, that's a momentum ignition type trade. Technically, I'd say it's a secondary momentum ignition, but the daily was so strong, it's a different kind of framework here. And you're kind of buying on the pullback, or however you want to frame that. I'm not here to kind of say, oh, you do this and buy on the pullback, etc. But there's a difference. And I think the key for traders is to decide which you're going to be. And you might be looking at that going, oh, I'd never buy that flag. I want to wait for it to break. That's fine. But have rules for when you get involved in that. And I always think, see the break, see the response to the break before you get in, because very often you kind of get that break to the high side and it fails and comes back, and we will look at that as a failure setup in a bit. But it's, hey, wants to hold. Is it holding? Is it holding? Okay, I think there's going to be a continuation. So that's how you're reactive. Predictive is the expectation is, I think we're going to get a blowout bar here. I think we're going to get a super wide range bar. So I want to position for it. And I think that's worth the risk that I'm going to take for that, and the fact that I'm in a little bit early. So that's something to really consider. Okay. So preempting momentum ignition, and I get ahead of myself here, so we might have to skip through some of these. Volatility contraction near a key level, multiple failed attempts. That's just, no one wants to pay up. No one wants to pay up, right? We all think, oh, the market's being manipulated and all this type of stuff. And sure, there may be an element of that to a certain extent, where the market trades to liquidity. However, when they're buying, they want the lowest possible price. So no one really wants to pay up, only when they're forced to. So you sort of sit in that consolidation, trades are being done, trades are being executed. You know what? I need to put my foot down on this. I need to get filled now. Okay, so expansion, contraction, there's your entry opportunity. And think, what would traders be doing here if they were trapped, as in they need to execute now? They would have to pay up. Another example here is gold as it's pushing through that low. You're seeing this. And this is, very often, traders looking at these as traditional breakouts, and fine, you can look at it like that. And there's different varieties of momentum ignition. But if you are preempting this, if you are playing the game of chess as a trader and saying to yourself, hey, you know what? If this does break out, I want to be in a position where I'm holding this. I don't want to be second guessing this. Maybe you can add on the break, fine. But as you start to look at everything all together, you say, hang on a second, where is the volatility going to expand? Stop losses, prior lows in this example, maybe through intraday highs, maybe at times of day, obviously with news, but then the things with news, direction's tough to get, right? Because you're second guessing what the news is going to be. So there's going to be volatility expansion, but you don't know the direction. Whereas with these type of trades, you go, hey, I think if we do break that level, direction's going to be down. I think we're going to get volatility expansion. That's what I'm trying to align with. How can I position? And so maybe a shrewd trader like you will go, hey, a little dip higher, I may want to get short there. Or as we reclaim VWAP, as we break through the low, and I'm going to look for the prior day's low, because I know that's a multi-day low, the days on the right. I know there's going to be stops there. I know there's going to be volatility expansion there. That could be momentum ignition candle that really starts a key move. And so you preempt that, put all the pieces of the puzzle together and say, you know what, that's worth it. Maybe you take the short as it kind of rocks back and you filled at 31.85, you stops at 31.98, say, and you go, you know what, it's worth a go, because actually, if we do break through the low and we do cascade, this could easily run on and on. And it's just thinking like that kind of chess mindset. Okay, so cycle back a bit. Let's think of this higher time frame and context. And this is the key. Honestly, this is the actual as dull as it is the key. If there, I hate using words like that, key, and this is the secret. There's no secret, but this is the kind of where the weight should go in decision making. So you're looking at the higher time frame and saying, you know what, where are we overall? So recently, DAX example, we're at highs, markets at highs, gold back then was at lows on the pullback. It matters. If you're in the middle of no man's land, no one cares. Nobody cares. And so it's unlikely to be a momentum ignition type trade. You want people to care and for more participants to have that sense of urgency. Remember, the time and price sensitivity, you want people who are super sensitive to time. They want to get in now, now, now. And that tends to happen when the higher time frame is setting up. Fresh highs, key levels, wicked out. You know the game. You know what it looks like on the higher time frame. A chart that you look at and go, that matters, versus a chart you look at and go, meh. You know what? Who cares? Because if nobody cares, it's very unlikely to get momentum ignition. More likely to be a grinding type trade. And fine, that's a separate playbook on itself. But if we focus on momentum ignition and that volatility expansion, then we need someone who cares. Oh, I need to get in now, quick, quick, quick. Get the order flow in, and if we preempt that, that's when we can kind of put ourselves in a really good position of power. So the higher time frame is so important. Look at this on crude as an example of nobody cares. Now it's a bit misleading, that arrow on the right, because I just took this from my own charts. That was the OPEC thing. Ignore that. We are like here. So this price here is right here on this far right. Nobody cares. We're in the middle of no man's land. We've driven up, we've pulled back. We're not even take out the prior highs, the prior lows. We're in multi-month ranges, and you see this technically momentum ignition. Technically, because you've got a real decent range candle, you've got decent volume, yeah. And that's very similar to the gold one. But would you take this? Absolutely not, because you're looking for the volatility expansion, not just direction. And whilst you might see this and say, hey, that's momentum ignition, I want to jump on this, I'm waiting for this low to go because it could fly, we'll get more momentum ignition. Just look at your daily, your North Star, the thing that is guiding you, and say, you know what, nobody cares here. We're in a 3-day range, we're in a multi-month range. There's no real fuel to the fire here. I'm not interested. Now, if this was at this high, this low, or after an ignition, a really ignition down the daily, then you might care. Like, okay, I'm going to preempt that, or I'm going to respond to that because I believe now more participants are coming in, volatility expansion. We're trying to, sometimes you've got to be careful, you're not trying to over predict. When you're in the middle, and listen, someone might say to me, oh yeah, but Mark, on this case, in this scenario, it did this and did that. There are always edge cases, and you're never going to get it 100% right. But if you tilt the odds in your favor by saying, hey, the higher time frame has to be right. I'm looking for that expansion. I'm looking for direction. And why should somebody care? Why should somebody be more? You think about what they're doing when they're time sensitive versus price sensitive. They're giving up money. They're saying, you know what? I actually want. It's more important for me to get in than it is to get the best price, right? You think about like panic seller or what they call them, motivate sellers when buying a house, selling a house, right? They're like, you know what, this house is worth 1.5, but I want to get rid of it, so I need to get rid of 1.2. That's costing the money, but time is more important. And so, from a trading perspective, you think we want to be on the side where participants are leaving money, if you like, on the table by just buying, or selling at whatever price, and we can ride that momentum, ride the coattails of that volatility expansion that can actually trigger even more because more participants start to get involved in it. Okay, so we talked a little bit about this, fake outs versus real momentum. Do we always know? No, we don't. But again, if we think about the volatility current state, I think is a very good benchmark for this. Are we already high or are we contracted? Now, there are some edge cases, of course, and perhaps recently is one where we've had extended levels of high volatility. But that's more of a cyclical nature on the market, is driven by news. And so you look at that from a different perspective and go, okay, we've got an elevated volatility on the daily, but maybe we get these like different pulses from an intraday perspective. So the time frame you're working on is the most important. But if the volatility is already mega high, you've already kind of done a big move, then you get a kind of big drive, bar breaks through highs. It's probably at the end of the move. It's not really momentum ignition. It's more a continuation bar, exhaustion bar. It's what the higher time frame alignment is so important, and also understanding the volatility. And talking about ranges. So if you're an intraday trader, this is really important. I think this will save you from some really awful trades. This is kind of taking from the topic of ATR, but it blends into momentum ignition nicely here. In that, if we have markets will run in ranges, right? Nasdaq will run maybe a $400 range, or the 24-hour session maybe does 200, but you kind of have an idea of what's going on depending on the day type. And if you're a swing trader, the weekly range is important. So if you start seeing traditional momentum ignition towards the end of the range, it's probably not a momentum ignition. It's not to be treated as momentum ignition. So in other words, your average daily range, let's say you've got on this on crude. I think I've got crude on. Yeah, it's crude. $85, right? You say, fine. Sorry, not crude. How could crude be $85? Gold, crude $85 range. Yeah, great. $85 range on gold. And you say, right, that's my average range. You see bars like that, which, okay, technically, you've got a big range, you've got a big volume, fine, but it's the end of the move. It's likely to be the end of the move. It's likely to be no more juice, and it's already run. And really, you've had kind of a momentum spike at the start of that move. So sometimes don't take things too literally, where you say, hey, hang on a second, that's a big range bar, that's a big volume bar. I want to get involved in it. You're like, no, hang on a second. Let me look at the context. Well, the bigger picture is so important, so key. And from an intraday perspective, if you're already running at the full ATR of the day, or the average daily range you're expecting, it could go more. Of course it could. But if you're running this trade 100 times in a row, then maybe you're pushing your luck, versus seeing that bar as it's just getting going, as it's breaking through a prior high, as it's really volatility starting to expand for a reason. Okay, so it's the higher time frame that's important. Quick word on time of day. So obviously after news, market open, US session open, obviously Europe session open and close, closing flushes. So why I like the momentum ignition towards the close, we've not seen it so much on this up move we did on the down move, is that the market will be consolidating. Maybe it's already down, consolidating, and then you go, hang on a second, people have only got half an hour to get the orders done in the stock market. If the stock market close, if I get short now and we start to roll over, I believe volatility is going to expand, because I think everyone's going to be super time sensitive and want to get out of the market before the closing bell. And so very often you get that closing flush, end of month, end of day, end of quarter. Look for momentum ignition out of the consolidation and important levels as well. Not just middle of range, but out of an important level is something that's very key. Okay, looking for trapped traders. So very often we see, I think what's that guy called? I can't remember the guy's name now. The guy called Liquidity Grab. What's his guy's name? ICT, right? So he rewraps all the stuff that's been going on for years and years. He's got quite a smart naming convention, I'll give him that. But these liquidity grabs, as he calls them, this is when you kind of adding fuel to the fire. And so, if you see price going under the prior day's low, and you see it doing some business up there, and then you see your consolidation here. So you can't see my cursor. Little trap here, liquidity grab, as he calls it, or whatever we want to call it, stop run, pulls back up, starts to consolidate above that level. Now you go, okay, higher time frame, check. Trap traders, check. Time of day, check. You might now be saying, hang on a second, that adds extra fuel to the fire. I want a position for this. Oh, it's chopped off that, sorry. Assume it's a wide range bar, because it is. I want a position because I actually think this is going to be the start of ignition. Now, this ended up ruining. I think this was the Friday. This was on the US dollar yen, and I think actually this was the time when we came out with the Moody's downgrade. So it was here. But this was actually looking quite strong from perspective of we've dipped below the low. It looks like we could fire off. The higher time frame is great. And so when you're looking for momentum ignition, you're not looking for middle of nowhere. You're just saying, hang on a second, if trap traders are there as well, it's going to add more weight to it. It's going to add more fuel to the fire. So however you trade, I've just used as a kind of example, but however you trade, if you see the market run in one direction, run back, contract volatility, then you go, hang on a second, That could be a trap. I assume a higher time frame looks good as well. I've seen the contraction of volatility. If I get the direction right, which I believe is this, because I believe that was a trap, and I think there's going to be expansion in volatility, now I'm really leveraging on things that are going to work. And so, something where we see these kind of traps, we see the ranges that often we get those consolidation ranges, I call them range break fakes, dips to the low, pulls back up, and then breaks the high side. Why are they so powerful? Because you've trapped a lot of traders. Now, this isn't again kind of talking too much on traps, but it's adding more fuel. And if you can imagine who's the most time sensitive trader, the trader who needs to get out now because they are trapped. You've been there, I've been there, we've been in a position, it's gone against us, and we need to get out. So we have to use a stop loss or we use a market order. And so if that's our thesis and our hypothesis is, hey, I think we have volatility expansion. I want to ride the coattails of those traders who are super, super time sensitive, not price sensitive. I've got a bunch of traders there who are stuck short. Over the higher time frame pressure, which is the high side, I got a time of day which I know more liquidity is going to come in. Okay, I've got my ducks in a row. If I cap my risk off, is this worth taking? Damn right it is. And so you start to layer up these pieces of the jigsaw to say, hang on a second, could I have a precursor for momentum ignition, or do I want to wait for momentum ignition? Okay, so another way to use these momentum bars is as a stop anchor, as a stop point. I think it's a very good place to put a stop. So if you aren't using it, well, you can kind of move your stop. But let's say you kind of saw the market drive up, you took a long on the pullback. The market shouldn't come back and retest the low of that ignition bar. It shouldn't do that. Now, I think sometimes it does come back into the bar, but it shouldn't return right below the low or below the high in the case of a kind of down bar. And so, if you're kind of, when I put my stop on this type of stuff, for me, if I see momentum ignition, what are the time frame I'm trading on, I'm like, hey, if my thesis of direction and volatility expansion is correct, which is what I'm trading for, right? And that's the whole point, then it shouldn't come back. Direction's wrong and volatility expansion's probably wrong unless it's expanding in the opposite direction. Like, I want the hell out of there if it's doing that. And so one way to use these, if you maybe don't use it as a trigger, is like, hey, I can use this as a stop. I'm assuming there's more participants that are super time sensitive here. Get the flush up. Okay, I'm going to bring my stop up. Get another one. I'm going to bring my stop up. And so, even that alone actually can be super useful. Okay, let's talk about the failed signal. So I like that. I mean, everyone reads my daily email. I send an email out every day, 11 o'clock UK time, without fail, Monday to Friday. Doing this for a couple of years now. And I mentioned about this failure pattern. Jason Shapiro has it in a much better way than me, news failure. I used to call it unexpected response. Just that, better at trading than I'm naming stuff. And the idea is that you kind of see something and price does the opposite. And we saw this news failure, if you like, on the OPEC, crude OPEC. OPEC were increasing production, crude then rallied, which it shouldn't do. We saw the news failure with the Moody's thing. That was the thing I sent the email out. The Moody's downgrade on a Sunday night. Monday, we gap lower and we rally straight away. Everyone saw it as a buying opportunity. So that's on a broader kind of perspective. However, if we look at this from a macro level, momentum ignition, if you trade it, you take your medicine, you take your stop. That's why it's so important to use a stop. But if you see momentum ignition in one direction, it drives, volatility expands, direction goes that way, and then it reverses. Very often that is a super signal in the opposite direction, especially when it's momentum ignition against all the things that are important, i.e. the high time frame trend, the time of day, the catalyst, the news, the sentiment, etc. How on the other day on the NQ, the Nasdaq, you're trading the CFD, drives the downside, grab momentum, good, all the stuff that you tick in the box, but actually it was a complete failure. And the better trade was to align yourself with the higher time frame, the sentiment, and use that as a trigger to get in. So, one playbook you can operate, and again, you do your own research and this type of stuff, is to have a thesis and a daily bias. So I'm going to stay long. I'm going to kind of stick with the buy side. I'm going to do this and do that. However, one of the setups you might look for is momentum ignition in the downside, a bearish momentum ignition that fails. Because why? Well, it's a very good place to structure your stop and structure the trade. Right, the price drives the downside here. 5-minute chart on Nasdaq. starts to expand momentum, volume picks up, range picks up, it's momentum ignition, great, here we go. And if you look, remember the gold chart, that was the start of the move, and it was like, yeah, okay, but actually the higher time frame suggesting a very, very different sentiment. As a kind of play for the playbook is, I see momentum ignition, right, I'm going to buy if we come back above that momentum ignition candle, a stop below the low here, and then run it for however you want. And so that's like that failure of, hey, momentum ignition, everyone's kind of driving to the downside, everyone's got some sort of time sensitive urgency to do, but there's no follow through. And if the higher time frame stuff and all the tick boxes are aligned with the other direction, that can just be a nice standalone playbook you can have there and go, hey, I want to get long. I don't want to chase stuff. I don't want to wait for pullbacks. I don't want to do this. I just want to see momentum in the opposite direction to my bias that reverses. And I've got a very clean way to get in and structure the trade. Very nice way to kind of look at these plays, I think. Okay, so just as a recap, we'll do some questions if you have any, guys. Standalone entry signal. So you're either using it to convert, adding to the trade as well. So that secondary kind of drive, second momentum ignition, drive, adding to the trade, and you're dragging your stop underneath it because it shouldn't come back. So volatility, expansion, and direction, you should be right. If it flips the other way, it's nice to have an exit trigger. But again, context is important. If you have it, the trade has already moved the ATR for the day, maybe it's tested highs, then you see that momentum ignition against you. Not necessarily go short, but actually if you're already in the trade and you're realigned long and you see it might be the end of the move, and kind of framing your stops under and behind that momentum ignition. So recap, momentum ignition is a trader's weapon. If you can learn to spot urgency and shift in flow, I think it's a very, very good place to be as a trader. And that is that expansion and contraction of volatility. And honestly, many traders miss this piece of the puzzle. And I understand it, right? Because we're looking at charts and we're kind of looking at direction and we say, I think that's going higher, but we never think of the other thing, which is the volatility expansion contraction. Like I will never take a trade myself if I think that the chance of the market contracting in volatility is high. Even if I've got a good feel for direction, I'm not going to take it. In fact, today is a great example, right? Yesterday, big range day, big gap reversal day, decent expansion in volatility relative to what we've done. Wide range day. Today, expected not a lot. We had some Fed speakers early on. It's kind of, even if I think direction is moved to the high side, which I still think we're bullish at the moment, nothing to indicate otherwise. If I think volatility is going to stay contracted, I'm not going to take the trade. Versus yesterday is like, hey, we're going to get the volatility expansion. I think we're going to get direction as well, align with that. And so what's the signal for that? It's your momentum ignition. Whatever time frame you're on, 15, 5 to 1, daily even, it's, hey, something's kicking into gear. People are way more sensitive, again, to time. I got the direction, got the higher time frame stuff. I believe this is the start of expansion volatility, which will work in my favor if I have direction correct. And so that extra piece of the puzzle really helps kind of structure trades a little better as opposed to just the kind of traditional technical analysis. And then we talked about using momentum bars for your entries. And then we talked about ads, but you'd add, if you kind of had the momentum bar. In fact, you know what, I did miss this. Let me go back. So ads, we talk about stops, talk about exits. This is important. Let me add this thing here. I don't know why I didn't talk about this. So if you were preempting momentum ignition, right, this is how you combine the two. Right, so you say, right, I'm preempting it, so I'm predicting, and I believe that there's going to be a volatility expansion out of the level. I believe we're going to get momentum ignition, so I'm going to position before. One way, an advanced way to trade is to then add as if you were reacting to the momentum ignition. So you take the two separate models that stand alone, blend them together, and say, okay, I want to be positioned if I start to see what I expect, the hypothesis, which is the volatility expansion, the direction. I am then going to add to the position and treat it as a standalone, drag the whole stop up behind that momentum ignition candle, and now you're in a really powerful position. So there is ways to trade both of them. Now, of course, if that comes with that added risk, of course it does. If you get it wrong, you're going to get stopped on. If it's not so much risky, but I think it's one way, a nice way of looking at stuff is having that prediction and the reaction, using the reaction as the add. But if you prefer not to predict, that's fine. Because sometimes, okay, listen, real world, guys, sometimes you look at it and go, it might go, it might not. I'll wait for it to go and I'll see the price response. So as it goes, you wait, you kind of see the price response. nothing much happens, you go, okay, well, I don't want it. So perfect storm is that higher, and also the higher time frame is not always in the beautiful position it is now, where you've got that hypothesis and you've got that direction, you've got that sentiment. Sometimes it's sitting there doing nothing, and you've got to make the decision: do I put capital at risk or do I not? And maybe it's just enough. And so you go, okay, you know what? But I kind of need to see something happening here before I get involved because I had so many fake outs the past few days. I'm going to wait. And so you adjust and adapt depending on the market regime you're in. Of course you do, but kind of one framework to have is, hey, can I predict this momentum ignition, or can I, be position ready? Because if I am, that really does put me in a position of power. I get a lot of unrealized P&L to work with. I get the opportunity to add to the deal. It does make it nice. Now, sure, we can't always get that, but my job as a trader and your job as a trader is to get that trade out of the risk zone into the cruise, as I call it. And there's no better way than being kind of positioned before kind of momentum ignition starts to kick into gear. Okay, I like this topic, guys. I hope you found this valuable. Let me have a look at some of the questions here. And I'll take a little breath. What subtle signs? Sandeep says, what subtle signs, structure, price, volume often appear before ignition begins? Sandeep, it's anything that contracts that volatility, right? So often we get the consolidation below levels. So that's going to be a slight decline in volume. In terms of structure, you don't want structure to be broken much, or it's broken and then consolidated. So maybe it's broken through highs, it's consolidated, volatility is contracted, everyone's calm, and then you're like, hang on a second, dips below the low, comes back, starts to pick up steam. You say, hang on a second, if it breaks through that high, I think we're going to restart going. And so, it's just observing the price on its own merit and the higher time frame kind of aligning to help you with that. Sandeep says, a second question here. If I miss the ignition bar, what's the most reliable re-entry pattern, e.g. wick test, inside bar? Good question, pal. I didn't go down this route because I thought we're covering enough here, but where is the recent trade that we had on the queue? Was it up here? So yeah, here we go. Okay, so one way to depend on the time frame you're trading. I'm itching my neck. I was biting me while I've been talking. Pesky gnat or something. Uh, one way to do this is to say, okay, listen, sometimes markets are super strong and you've got to pay up, and you go, you know what, it's super strong. I'm getting these little bursts. I'm not pulling back. I've got to pay up. Maybe it pulls back to something like a 10 period moving average in 1 minute. That's not a bad play. Or maybe you look for a deeper rotation if it's more a more rotational type market. Um, the the name of the game, again, I always like to look at it like this, is like, can I get mini contractions in volatility? So, and then we start going down the time frame. So this is a 1 minute chart. We had that momentum ignition. Let's say you missed the ignition. By the way, you're not trying to catch if you're preempting it, then you're on it. But if you're not preempting it, you're not diving in. Maybe I should have been more clearer. If you're preempting it, you're ready and you're positioned, great. If you see the ignition bar, you wait then, for, like you said, Sandeep, for the optimal entry or the optimal as you can get. And that for me is, let's imagine that's a volatility expansion. Here we've got a little bit of a contraction volatility, maybe not quite so much, but here is, yeah, the range of the bar has gone lower, volume's dried off, and we haven't really pulled back much. Now, the pure technicians would say it's a nice bull flag, fine, whatever you want to call it, but that to me then is the expansion volatility, the contraction, and I'm now going to expect volatility to expand again, and there's no reasons for me to think that this hasn't got more legs on it. And I understand the further and further it goes intraday, we start coming to the zone of we've already done the ADR move. Maybe I shouldn't be buying this. Like here, you're like, kind of quite stretched now. Risk reward might not be so good unless you're already positioned. It's difficult to buy that. I get it. But if you're still quite early on and you still look at the daily chart, and still your range is capped out, and you go, hey, the range could be $400 here. We've only done 250, plenty of meat on the bone. Okay, fine. Look for that expansion and contraction of volatility. And then, is there some sort of ignition at it? And it's never going to be quite as strong, but then you're kind of defaulting to the normal kind of trend type environment then. But you know what, wick test, any kind of thing like that, where you get a kind of dip that fails, move to the downside, flushes straight back up. Any of those tape signals that you obviously know, Sandeep, that go, hang on a second, this is worth jumping on. Inside bar, yeah, I think this inside bar is okay. Maybe a breakout of that inside bar, the subsequent bar after that 3-bar triangle type thing. Gary's has to leave early. Very helpful as always. Thank you, Gary. Appreciate your feedback, pal. Scott says, hi, Mark. Is there any benefit to having the ATR length different to your chart time frame to help identify early ignition? So I have an ATR here. It's actually the range of the bar. So it's just one ADR. Technically, it's a range of the bar here. And I overlay a 10 period ATR. I didn't have it on this one, but I overlay it here so I can see how it is relative to the kind of average range. And so, I'm looking for the range of the bar compared to the average range. Now, the danger you have with the average range is it takes a while to catch up, like a moving average does, like any kind of running average does. But if I'm observing, let's say I'm observing here, and I see it, and this is the range of the bar, all of a sudden this stands out. Now, this is not huge, but to be fair, you've already had like a reasonable expansion of volatility. I'm expecting a little bit more. So I'm comparing the current range of the bar with the typical range, if you like, or the average range, if you prefer, of the previous bars to give me an idea that there's a volatility expansion underway. Robin, what defines a true ignition bar versus a normal strong candle or an exhaustion move? That's a great question. Okay, so to me, an ignition bar is the start of a move. And you know what? This shows you're thinking about this, Robin. So appreciate this question, pal. And listen, we never know if it's the end of the move or the start of a move, but we've kind of, if we're looking at this and I see this here, it's not the start of a move. I know it's for sure. I don't know if it's the end of the move, but I know it's not the start of the move here on this bar here. Whereas here, I think this could be the start of the move. And so, again, I don't know, could reverse, fine, that's what my stop loss is for. But if you start to see that momentum ignition or that wide range bar, and we've already been trending for a while, that could be the end, or it could be a continuation. I certainly wouldn't be, for me anyway, initiating a position on that. Or if I'm very, really careful about it reversing, maybe you're adding to a position, a small clip onto your core. And so I guess I've got a sort of a succinct answer. If it's probably okay, have a look at the chart. So if it's a wide range bar, wider than all the other bars in the direction of the move, and you've still got more meat on the bone, maybe you've looked at your weekly ATR, your daily ATR, whatever it is, then that potential ignition bar. If it's towards the end of a move, or if the move's already been going for a period of time, then I'm cautious of that. I'm like, okay, if I really think there's loads more left, I'll take the continuation, fine. But it's a different setup. It's a different framework. I look at that and I say, I don't think it's a momentum ignition. I think it's just a continuation bar, like you say, it's a normal strong candle. And so, momentum ignition is very much, hey, this is the start of a true momentum move. And I believe this is the bar that's igniting the whole thing. This is the fuse that's lit. Okay. We're going to see previous webinars, Eric says. Pepperstone will send you a recording, and I also think that after a couple of months, they will put them on their YouTube channel. How do you avoid being too early? What confirms ignition is actually underway? How do you avoid being too early? What confirms ignition is actually underway? So I think the higher time frame is so important, right? Higher time frame. Thinking about where price position is, thinking about the time of day, at the open, the end of the day. You never know for sure, right? You never know for sure. I'm not here to tell you this some sort of holy grail. However, if you can look at the bigger picture and say, you know what, actually, this could be the start of something. I'm going to think about the daily candle, how that could print. This could be the start of that move. The daily candle's got to print something. I think that it's going to be a reasonable range. So this ignition could be the start of something. And sometimes you're going to get faked out, right? But if you have a filtering process that says the higher time frame's got to be on point, I've got to have the sentiment in my favor, and the ignition bar has got to be from that volatility contraction to expansion, it at least puts you on the right side of the deal. It at least puts you looking for the right kind of stuff. Now, sometimes you're going to get it, spikes, comes back, pulls back. But the point is that when it does work, because you get the volatility expansion and direction, then I think you get a decent RVR on the trade, even if you kind of win rate isn't that good. Sandeep, how important is volume confirmation in spotting real ignition versus noise? Sandeep, I believe that volume is correlated with range, and so generally the range is more important for me. Why? because I don't think I'm right or wrong on this. I just know this is the framework I look at stuff. You think about a wide range bar, that means someone's paying up and paying up and paying up and paying up and paying up. They are truly time sensitive, not price sensitive, right? It indicates to me that they're prepared to pay way more in that short period of time on the bar than they were the last 20, 30 bars ago, or last whatever me average, right? Now, if you have a bar that has high volume, just high volume, and not a wide range, that tells me that there is a large buyer and a large seller transacting, which is not what I want. I don't want to necessarily see that. I want to see the transaction of, hey, I want to see buyers stepping up, stepping up, stepping up in the case of a bull bar, right? And sellers not hitting, not combating that. If it kind of I see a large spike in volume but price not going anywhere, I'm like, hang on a second. Every buyer's got to be a seller. That means there's a kind of a match. They've met their match, and that to me is not what I want. I want to see volume, but I also want to see the price go with it. And we tend to have large range bars that have wide range volume as well. If you get one where you wouldn't have wide range volume, it wouldn't bother me too much. It's still more. In fact, thinking about it, if it was a low volume bar with a wide range, unless it was the middle of the night, of course, and the liquidity was low, I'd be like, hang on a second, they were prepared to pay up that much and they didn't really get filled that much. Well, we could really, really rip. So we're thinking about the dynamics of price and how orders are executed, right or wrong, pal. We don't know for sure, but we're trying to tilt the odds in our favor. And good trading is all about stacking layers of edge. Higher time frame, sentiment, position in range, volatility, expansion and contraction, this, that, and the other. Okay, what's your favorite failure setup after a fake ignition move? How do you catch it? Sandeep, it's that drive higher that sucks a load of people in. Volatility expansion drives to the high side. It reverses, takes out that low bar, and everything just changes completely. That's what I want. I want to see kind of people are moving in one direction, driving one direction, the time sensitivity, and then it reverses. But only when the higher time frame aligns with my thesis, because that's the direction. The expansion volatility is one thing, but the direction obviously is super important as well. How would you combine? David says, how would you combine time frames? So, like when you enter on the 1 minute, how are you building the idea of momentum ignition? What's the top-down process? How would you combine? So, my top-down process, David, is to say, okay, what's my thesis for the day, or what's my bias for the day? And maybe we can do this. This might be a great in-depth webinar. But ultimately, I'm coming from my bias for the day. I want to position along. Okay, and now I say, right, I'm going to either predict or try and predict our momentum ignition, or I'm going to jump on momentum ignition, or I'm going to blend the two. Now, I don't know how the day might play out. No one knows. If it just rips off the open and flies and keeps going, then fine. But very often we don't get that. Very often we get consolidation, then it goes, drive, flag, then it goes again. Maybe we get a test lower that drives lower, traps a load of traders, and then kind of pulls up, holds above the VWAP, and then the momentum ignition is there. There's various permutations of it. And so, whilst I might have, several ways that momentum ignition can show up, it has to align with what I see on the high timeframes. There's no way I would take momentum ignition to the downside in the current environment we're in now. Now, if there was a news came out, changed, repriced it, that's a different setup completely. But I want to have an idea of how I want to position. I want an idea of what I want to see price do, and then the momentum ignition is like a trigger. It's the trigger, and it's the kind of thing that says, okay, I see it, I want to get involved in it, or I believe actually when we take up this high, that's going to start the momentum ignition, so I want to be on it beforehand. But that's a good thing. Maybe I can share that at some point. Maybe it'd be valuable to some people to see kind of the process of the checklist go through each day, how you build the roadmap up. That might be quite valuable. Thank you, David. Robin says, what's the difference between a valid wick test and a trap after fake ignition? Yeah, that's a good question, Robin. So I genuinely think if we've had a really good ignition, we'd have a wide range, because that's a definition of ignition to me. So for price to come back, the quicker it comes back, the more likely that's a trap. Sometimes you're right. Sometimes you get a drift lower, it tests like in the bar, but again, that should hold if it's genuine volatility expansion. What I'm really looking for with the trap is that it comes back quite quickly, And it's like, hang on a second, a lot of people are super, super time sensitive there for no reason. They've actually made their own decision, and ultimately now the other side is kind of winning the war. And so context is important there. And you're right, sometimes stuff will come back and test. And you've got to, listen, nothing's black and white. Sometimes it will just drive on and on. Sometimes it will kind of revert. But you don't really want it coming back to the scene of the crime. Otherwise, the thesis is wrong. Now, could the trade still work? It could. But if your thesis is, I believe there's volatility expansion and direction, then you kind of don't want it coming back. Oh, some good questions here. Thank you. David says, isn't the daily really too far from the 1 minute to impact a decision? Also, when you say higher time frame and I'm on the 1 minute, which higher time frame do I rely on? David, daily, mate, daily. I'll tell you why the daily, and let me kind of hopefully convince you. And you know what? I can't convince you, pal. That's the wrong phrase. But the daily is what matters to everybody with any kind of decent balance, any institutional trader. Forget about the high frequency guys, but they're all looking on the daily. They're all looking about what was the closing price, what was the high of the day, the low of the day. Those are the metrics that matter. And so when you get a persistent daily trend on a 1 minute, you might be like, yeah, but Mark, there's opportunities on the short side. Maybe. But for trend, if you're assuming trends continue, and listen, I don't make the rules, they do. The trends do continue until they stop. And most of the time they go further than we expect. For an uptrend example to continue, we have to be taking out highs, holding at highs, taking out highs, higher highs, lower highs, right? Sorry, higher lows. And so by the nature of that, why should we not just align ourselves with the higher time frame? If we believe the market's pushing higher, then even if you're on the 1 minute, make life easy for yourself and only trade long. And so I'm not saying you can't short, and there's a time and a place for it, maybe quick scalps on the short side, but you're really swimming against the current. And so the reason we look at the higher time frame, and I think the daily is the North Star. I think no matter what time frame you trade on, the daily should be that kind of thing you check every day. Sure, it doesn't change much, but if you think about how the 1 minute chart formulates, it formulates based on that daily candle. It's going to be a doji, it's going to be a big fat green, big fat red one with a wick. And so you kind of start to then framework out how that 1 minute will behave. And so, I see what you're saying. You're like, hang on a second, I've got the 1, I've got 3, the 5, the 15, the 16, daily's right up there. Do I really care? Well, maybe you don't, but it helps you align with that direction. And what that does, David, is it helps you to focus on one thing at a time. So if you're on that 1 minute, right, and you say, hang on a second, I only want to align with longs. When the market is selling off at the opening bell, you're not looking to jump in short. You're looking for it to trap, come up, maybe consolidate above the open, and then ignite and then go up. And you say, okay, that's what I'm waiting for. So it helps you stay focused on the job in hand, which is how do I get a good long? Now, maybe you trade a different model. You say I trade a reversal model or a trade exhaustion, and you're not looking at momentum ignition. That's fine. But I think there's more than enough meat on the bone with any of these markets that we look at to have some kind of bias and some kind of alignment and say, hey, the daily time frame is up. I'm assuming that's going to continue, right or wrong. So I'm only going to look for longs on the 1 minute. And if you think about how that has to happen, they have to have the green candles for it to continue. And so a 1 minute has to continue higher. So if you align with longs, you can be a little bit, poor, if you like, with the execution. You can be a little bit late to the deal. You can hold on trades a little bit longer. It's a bit more forgiving when you're aligning with the trend. If you're trying to short an uptrend, I'm not saying it can't be done, but you're making life hard for yourself because you've got little chunks. You think about how price goes in uptrend, you get little chunks, and that's it. And if you're late and you miss it, it whips back. So that's why I always look at the daily. Is I think it should be a North Star, whatever time frame you're trading, and you use it to kind of make your life easier. And say, and I know what you're saying. You might be saying this, and some people might be saying this. Well, but Mark, I'm limiting myself. I'm not gonna. I don't want to limit myself to just longs on the day when I could be trading shorts. Okay, fine. But here's something I'd ask you to do. Go back and look when the daily time frame is trending, and look at all the trades you took in the opposite direction versus all the trades you took in that direction, and see which ones play out the best. And almost without question, you are going to see that it's way, way better to trade on the long side. Now, if you want to allocate double risk capital on the day on those, then I think that's one way you can approach it. But you're trying to trade both sides when the daily is in a very obvious trend. Now, listen, it could reverse tomorrow, right? It could reverse and go back to lows tomorrow. We have to have some faith in something out there and make some assumption. And sometimes the daily's mixed, right? And maybe you do trade both ways. But it's that higher time frame approach, I think, and it helps you become more like a sniper. And just like that example I gave there, if you're seeing the market hammering to the downside and you trade both, you're like, oh, should I jump on short? Should I wait for a pullback? Whereas if you're like, I only trade long, let me let this play out. Let me see where it goes. The lower it goes, the deeper the trap. You let it go, comes back, not yet. Maybe you see a double bottom. That's your thing. You're like, right, now's my long, and it just helps you become more precise with your entries. But it's a very valid question. It's like, why should I even look at the daily? And again, I know people who don't even look at the daily. They say, I've got my structure, I've got the way I trade, and this is how I like to do things. But I like to think, hey, I've got confidence that I'm aligning at least with the rising tide. Rising tide lifts all ships. Let's run through a few more questions. Sue, hey Sue, how you doing? Also, can you apply this to daily charts? Yes, you can. Yes, you can, absolutely. Daily charts for 1 minute, 5, 15, and especially on the dailies. And actually, if we go back to David's question, that's I would layer that in with a 1 minute. So we had the volatility expansion after the China deal. Okay, great. We start to see volatility expansion. I expect to continue for a few candles. I'm definitely only aligning long intraday, and I'm kind of then nesting these volatility expansions and contractions. So yeah, you can use them in the higher time frames. Sandeep says, many thanks for today. Excellent presentation. Really appreciate the answers to all my questions. You're welcome, Sandeep, and thank you for the feedback, pal. Let me move you over here. Oh, I can't move you there. Okay, I'll just finish these off, and I'll get through these because these are great questions. Can you pre-position before ignition without guessing, and if so, how? We never know, mate, Robin. But as talked about before, if you just pause for a second, push your chair back, and say, if this breaks that high and gets going, what could we do? And you start to think the game of chess of, well, actually, we could run on quite a bit here. Okay, so should I buy it now and be ready for that ignition? And the answer might be no. I don't want to. I don't want to. I don't like the daily time frame. We've got data coming up. There's all the signs it's a rotational day. No. Fine, but playing the game one step ahead or 5 steps ahead really allows you to position and say, I don't know the answers to this, but and you never know the answer to trading, right? You can't de-risk it completely. But if I'm right and I get direction right and I get volatility expansion right, I'm going to be paid well for the risk I take. And that's really the job, right? Our job is to say, hey, you know what? I want to take X units of risk and I want to make as much as I possibly can with the least amount of risk. And so when you see trades where you go, you know what? This is an asymmetrical risk reward trade. I think it's maybe a little bit more than 50-50. Maybe I think it's higher than that. But actually, if it works, it's going to pay me well because I'm going to be right at the start of a move. My stop is here. Yeah. And so the name of the game there is to really, play this chess game of where could the market go. And that's why I'm a big fan of the daily time frame, because I go, well, the market could print that green candle. And if it does, it's going to kind of, make it look as if it's continuing the trend. And so this little dip today might just be a little tail on that candle. And so it's trapped there, and you start to nest all these layers of edge so you can position yourself and say, my risk is managed, but if I'm right, I'm going to be rewarded very, very well. You don't need too many of those. But, without guessing, we were always guessing. We're just making educated guesses, and I think by thinking multiple moves ahead, you can kind of say, well, actually, if that does happen, I think that's got a very good chance of running strong. That could be a 5-hour trade for me. And I think it's a good place to go. Or should I wait? Because you start to play that game as a trader of when you want to allocate risk capital. Quick one, David, how do other time frames like 60, 50, 5 help confirm the daily momentum for 1 minute entries? I think it's just, it reduces the noise. Like I like to look at the hourly or 15, depending on what's going on, as well as the daily. But if it's like now, NASDAQ hourly, I've got up there chopping around. I'm like, you know what? Nobody cares. Back to that thing of nobody cares. Daily's still nice, still holding at highs, still bullish. But at the moment, that hourly, nobody cares a bit. So I'm definitely not going to look at the 1 minute. So it's like a filtering process where you go down. Nuno says, thanks, Marks, as always. Context is key. Absolutely, Nuno. You've got it, pal. It is. And it's the most important thing, man. Robin says, Are some times of day or market conditions better for ignition setups? Yeah, open. I wouldn't take them at lunchtime and the afternoon, like power hour, people call it. But after, if we've had something interesting happen, so two examples there is you've had a drive, had a consolidation VWAP pullback, maybe it starts to creep up. You might think, hang on a second, we've got 30 minutes left. There might be some more urgency there. Um, After data, you've got the volatility expansion, but direction is difficult to get. But if you get the failure, often that's pretty good. Follow the path of least resistance, as I've heard said many times. Justin, you put it very succinctly. Thank you, pal. Yeah, the path of least resistance. Make life easy for yourself. I've been there, guys, where I just fought and fought and fought and trying to be smart. There's opportunity on the short side. It's like you're taking your resources, your capital, your mental focus. It's like you're gonna find a good long. You don't need many good longs if you or short, whatever you want to align with. When you're looking for so much stuff, what's that proverb? Chinese proverb: "Man who chased two rabbits catch none." You know, be the man who chases the one rabbit. Um, okay, thank you, Justin. Mark says really informative. Thank you, Mark. Thank you, Mark. Massive thanks, Mark. I've never looked at this. We'll do some more research. Justin, thank you, pal. Robin says that was the best webinar I've seen. Thanks so much. Hey, mate, that's high praise. Appreciate that, Robin. And Victor says, thank you, Mark. Another dose of wisdom well received. Thank you, Victor, and thank you, ladies and gents, for all your questions, feedback, attention. Great questions. Makes this stuff worthwhile. I like sharing this content with you, and hopefully you can take bits of it and make yourself a better trader and get some better results from it. Anyway, guys, thank you very much. We're back in next week. Take care. Appreciate you all. And we'll call it an evening there. Goodbye.